PepsiCo just posted $24.18 billion in quarterly revenue, yet their underlying cash flow paints a deeply contradictory picture. Is this global snack giant truly accelerating, or is Wall Street ignoring a dangerous cycle of debt-funded payouts hiding beneath the surface? We must uncover the truth by applying rigorous fundamental analysis. Second quarter net revenue hit $24.18 billion, representing a 6.4% year-over-year revenue surge. Most analysts are focused on this top-line triumph, attributing it to PepsiCo achieving its highest global organic volume growth rate since 2022. But examining the core North American food segment, net revenue actually declined by 2% due to lower effective net pricing. Consumers buying physical products like bags of Lay's potato chips and 12 packs of Doritos are finally pushing back against endless price hikes. Families are actively trading down to generic brands or skipping the snack aisle entirely. This rapid shift forced PepsiCo to implement targeted price cuts of up to 15% just to maintain physical volume on grocery store shelves. The golden rule of fundamental analysis is that booming international demand cannot perpetually mask a domestic pricing ceiling. When your primary home market demands immediate discounts, the overall corporate growth story becomes incredibly fragile. This is exactly why deep stock market analysis is required, because looking only at the global top line blinds you to underlying regional weakness. To fully grasp why this pricing pressure matters, our stock market analysis must look at an even more surprising number. Reported operating profit exploded by 125%, landing at a massive $4.02 billion. The financial headlines are screaming about this sudden profitability win, alongside earnings per share surging 137% to reach $2.18. At first glance, this 137% jump in earnings per share looks like a masterclass in corporate execution, but any disciplined investing strategy reveals it is simply an accounting illusion hiding in plain sight. This optical jump was caused entirely by PepsiCo lapping a massive $1.86 billion non-cash impairment charge from the prior year related to the Rockstar Energy brand. If we meticulously strip away that historical accounting noise, the core operating margin actually contracted slightly to a relatively flat 16.8%. What does this 16.8% core operating margin mean for your value investing approach? Never take headline growth rates at face value without isolating one-time anomalies that artificially inflate the current numbers. Beneath the daily market hype, PepsiCo is operating with very stable but completely unexceptional underlying profitability. The true operating leverage they promised investors is simply not materializing in the actual financial data we are reviewing today. Once you grasp this vital lesson of value investing, you will view corporate financial reports in a completely new light. This vital lesson brings us directly to how PepsiCo actually rewards its loyal shareholders. Year-to-date net income reached a seemingly healthy $5.34 billion. The consensus view assumes this massive reported profit easily covers the $3.91 billion in cash dividends paid out over the exact same period. But proper fundamental analysis teaches us that accounting profitability is definitely not the same thing as actual business liquidity. Looking at the actual cash entering the business, year-to-date free cash flow was an alarmingly low $1.10 billion. To bridge this massive shortfall and keep quarterly dividend checks flowing, PepsiCo was forced to issue $2.97 billion in new long-term debt. They also heavily relied on a net increase of $1.27 billion in short-term borrowings to cover their massive cash deficit. This is something you can easily check for yourself, and it is exactly why relying on just one profitability metric ruins any investing strategy. Funding massive shareholder returns with continuous external borrowing is an inherently restrictive capital allocation choice. Eventually, these rising interest expenses will begin to aggressively eat away at their core operational profitability. Any sound investing strategy must severely penalize a business that is actively borrowing money just to pay its current owners. So, where exactly is all that reported profit disappearing before reaching the corporate bank account? To see where the money is disappearing, the cash flow statement reveals a massive $1.86 billion absorption of cash tied directly to accounts and notes receivable. The market crowd is completely captivated by the 7.3% year-to-date net revenue growth, ignoring the fact that this uncollected revenue is ballooning right under their noses. When a company books a massive sale of physical inventory, like shipping thousands of pallets of Gatorade to retailers, but hasn't collected the cash yet, the value sits trapped in receivables. This $1.86 billion drag on operating cash flow casts immediate doubt on the true quality of PepsiCo's reported earnings. If major retailers are suddenly taking longer to pay their massive invoices, it signals serious potential liquidity friction on the near horizon. Revenue is pure vanity, but actual cash flow is ultimate sanity. If this trapped cash isn't rapidly freed, it leaves that $1.10 billion in free cash flow completely useless for funding true business expansion. This dangerous working capital drain logically impacts the broader structural integrity of the corporate balance sheet. Total debt now sits at a towering $53.21 billion. Many passive investors see PepsiCo as an unshakable consumer staple, remaining completely blind to its highly leveraged debt-to-equity ratio of 2.41 times. Adding to this immense pressure, the current ratio plummeted to 0.93, meaning their liquid assets barely cover their immediate short-term obligations. This critical 0.93 current ratio leaves PepsiCo highly dependent on continuous commercial paper refinancing to fund everyday operations. They need this constant refinancing just to handle routine bottling plant maintenance and pay those massive quarterly dividend obligations. Operating with a leveraged balance sheet carrying over $10.6 billion in immediate short-term obligations paired with negative working capital leaves very little room for strategic error. This is especially true when domestic consumer spending aggressively slows down across the broader retail economy. When commercial debt becomes expensive, these massive structural liabilities transform into a heavy anchor on future corporate growth. These liabilities trap the management team in a difficult corner, forcing them to prioritize immediate debt service over vital product innovation. This is a classic trap in stock market analysis, where investors wrongly assume a brand's household name guarantees absolute financial invincibility. All of these underlying financial constraints will heavily dictate how the broader market interprets management's future operational promises. PepsiCo just recently reaffirmed its fiscal 2026 guidance, confidently projecting 4 to 6% core constant currency earnings per share growth. The general expectation is that global pricing power and aggressive internal cost-cutting will easily carry them directly to this ambitious growth target. However, the most critical promise they made to investors is hitting an 80% free cash flow conversion ratio for the full year. Given the severe year-to-date cash flow deficit we just uncovered, achieving this 80% target requires an unprecedented rapid reversal in working capital. They must execute this massive financial turnaround over just the next 2 quarters. With the US inflation rate ticking back up to 4.2% in May, physical input costs like raw sugar and aluminum packaging are steadily rising. At the exact same time, everyday consumer grocery budgets are actively shrinking due to broader economic pressures. You must always cross-reference optimistic forward guidance against the harsh mathematical reality of the corporate balance sheet. Expecting a miraculous corporate cash flow recovery to hit that 80% target in this specific retail environment requires everything to go perfectly right. Let's bring this all back to our fundamental opening question that sparked this entire investigation. Is the broader investment community dangerously ignoring a vicious cycle hiding beneath the surface? The fundamental truth is that while PepsiCo commands incredible international brand loyalty, the business is currently trapped in a deeply flawed cycle. This is a cycle where $5.34 billion in reported profits vastly outpaces actual cash generation. The fact that this consumer goods giant is borrowing $2.97 billion in new long-term debt to fund its dividend payout is the ultimate reality check for any dedicated value investor. PepsiCo is a formidable global market player, but it is currently operating on a highly precarious financial tightrope. For For the prudent individual investor, the current corporate valuation demands intense caution and extreme patience. Unless management can aggressively reverse this $1.86 billion buildup in uncollected receivables, the dividend remains functionally debt-funded. Protect your hard-earned capital, demand a much wider margin of safety, and always follow the actual cash flowing through the business rather than just headline earnings. But I want to hear your take on whether PepsiCo's international growth will save them, or if this dividend strategy is a ticking time bomb. Let me know your thoughts down in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.